Okay, so let's get right to it. I'd imagine several of you are still unsure what the 457F regulations are. Technically speaking, and try to stay awake as I say this, IRS Code Section 457 provides rules for determining when an arrangement is a deferred compensation plan and whether or not the plan qualifies for favorable tax treatment. Historically, sick and vacation leave plans were exempted from 457. However, the proposed regulations narrow the exemption to only include bona fide sick and vacation leave plans. So the major change here is the term bona fide and what that means once the final regulations are released. If your plan is determined to be bona fide, you'll be able to breathe a deep sigh of relief as you won't have to change anything. However, the IRS is considering many factors which run contrary to common practice. And the adverse impacts are why we are keeping our eyes and ears open for any sort of guidance or clues that tip us off how the IRS will proceed. So naturally, you're probably wondering what exactly will make my plan bona fide. The factors the IRS will look at include whether the amount of leave provided could be reasonably expected to be used by the employee in the normal course of employment. Limits, if any, on the ability to exchange unused accumulated leave for cash or other benefits, and whether the payment of unused sick or vacation leave is made promptly upon severance from employment. As you can see, the factors are extremely vague and quite subjective. So it might be helpful to back up just a bit and talk about what the IRS is trying to accomplish here. Some may argue this is a way to increase tax revenue, and that would be valid. But officially, the IRS feels they're simply trying to apply the law to current practice. For quite some time, the IRS has felt significant leave balances are really just a form of deferred compensation. As such, they have felt it's unqualified and should be subject to taxation, both federal income tax and FICA. Now, while the IRS is still sorting out the technical details on the new regulations, what is clear is that the regulation may be one of the largest tax changes to face the public sector in some time. As a result, we have been working closely with our legal counsel, Groom Law Group, who are headquartered in Washington, D.C., to ensure that we are understanding the provisions correctly and to help us reasonably predict where the IRS is headed. And due to Groom's close working relationship with the IRS, they've been working directly with the IRS's counsel to determine the service's stance on the issue. The information received has been invaluable in preparing this guidance for you. We are also doing our best to influence the IRS's behavior. We have provided comment letters for employers to send to the IRS, and through Groom, we've provided specific information to encourage safe harbors or specific guidance to ensure that it's easy to comply with whatever the final rules state. Despite all of our efforts, we don't know what the exact language that will be handed down by the IRS, but the final intent is very clear. They've given enough guidance, both officially and unofficially, like the time where they reached out to Groom for assistance in drafting safe harbor language, only to tell them they had to stay within very strict guidelines or they would ignore their feedback. But that guidance allows us to see how this could likely impact you. Please keep in mind that the regulations at this point are only proposed, which means they don't affect you, but we've identified 5 distinct areas that could be negatively impacted if the regulations are finalized as currently written. First and foremost, additional taxation if your plan's not considered bona fide. Second, a loss of a valuable benefit to your employees, which will encourage absenteeism. Third, new HR hurdles that will become additional administrative compliance and staffing burden, increased workloads for the HR departments, and fifth, for educational employers, this may have an adverse effect on the quality of the education that's delivered to the students. While I've mentioned this a couple of times already, if the regulations are finalized, the plan designs that aren't bona fide become subject to taxation. But that's only part of the equation. The tricky part is determining when the value of the leave is taxable. In technical terms, the value becomes taxable when the individual no longer has a significant risk of forfeiture. I'm going to explain that in a couple of examples, and it is a bit complex, so a couple of quick caveats to remember as we go through them. The rules are still proposed at this point, but we're basing the examples on how the language reads in the proposed form today. Also, these examples only apply to leave plans if they wouldn't be considered bona fide by the IRS. So the first example, if an employee is guaranteed to be paid their leave balance at separation of service, meaning you automatically pay out their leave when they separate, there will exist no significant risk of forfeiture. In this scenario, the value of the unused leave at the end of the year becomes taxable to the employee and subject to FICA for both the employee and you, the employer, if the position is required to pay into it. In this case, the employer simply includes the value of the leave on the employee's W-2, but it's important to note, the employee isn't actually paid the value of the leave, even though the leave is subject to taxation. To explain it a step further, let's pretend Bob, a firefighter, gets 10 days of sick leave each year. Bob's allowed to accumulate sick leave indefinitely. And at the end of the year, Bob has 8 days of sick leave remaining. At the end of the year, you would add the value of Bob's 8 days to the W-2, pay both the employee and the employer portion of FICA, if applicable, and then the 8 days would roll over to the following year, as it currently does today. A second example, if the employee is only paid the value of their leave upon reaching a specific event, such as retirement, then a significant risk of forfeiture exists. The value of the accumulated leave then only becomes taxable once the employee meets the requirements of the event. Let's consider Jane. She's a 46-year-old teacher, and her employer has a retirement policy that states she's eligible for retirement once she reaches age 55 and has 15 years of service. Also, the district's policy only lets her receive the value of sick leave at the time of retirement and doesn't cap the amount she's allowed to accumulate. To date, Jane has accumulated 20 weeks of sick leave. Because she still has to retire to receive the funds, and retirement isn't guaranteed at this point, a significant risk of forfeiture exists, and the value of the 20 weeks of leave is not taxable. But let's fast forward 9 years. This year, Jane turns 55. And since she's already worked more than 15 years for the district, she is now eligible to retire. Also, her sick leave balance has grown to 38 weeks. As a result of being eligible for retirement, a significant risk of forfeiture no longer exists, as she could retire tomorrow. So the value of the 38 weeks of leave now becomes taxable to Jane, whether or not she decides to retire. As well, the 38 weeks of leave are now subject to both the employee and employer portion of FICA. Simply put, without alteration of common plan designs, the employee and employer could be taxed on the value of the leave, or what the IRS really refers to as deferred compensation, as if it were income, even though the employee hasn't physically received those dollars. The second issue we see, in addition to taxation, is a loss of benefit. For years, employees in the public sector knew they would be rewarded if they didn't use their leave. Sure, everyone wanted the employees to use sick time if they were really sick, but if they used their leave judiciously, they would end up with larger banks of leave. If the employee became severely ill, they could use the leave similar to a disability policy, or if they didn't use the leave at all, they would typically be paid out at retirement or separation. And often, the value of the leave was paid through a tax-sheltered vehicle such as a special pay plan, an HRA, or even used to purchase service credits in their pension plan. If the rules are finalized as currently written, the leave balances won't be eligible for favorable tax treatment, causing the employee to lose out on this long-standing benefit. Third, the finalization of the regulations could have a significant impact on HR teams. If employees are now forced into a use it or lose it mentality with their sick and vacation time, this will naturally result in employees attempting to use all of their time each year. And the ripple effects are numerous. There will be a greater staffing pressure on employers and an increased need to find substitute teachers for educational employers, a greater reliance on temporary, part-time, and seasonal employees, and depending on the future of the ACA, or potentially any replacement healthcare plan, the increased use of variable hour employees increases the tracking and reporting burden. Once the IRS finalizes the regulations, they are not likely to issue any grandfathering provisions. They've stated this more than once. As a result, there will be an urgency to amend leave policies to avoid adverse impacts. This sudden and new operational burden will certainly be a strain on benefit staff. Additionally, employers will need to budget for a sudden and significant cost, and that's that tax burden that we talked about in the first issue, and will likely have to do some damage control with current employees that have significant amount of accrued leave on the books. And finally, for educational employers, we are concerned that the finalization of the regulations could negatively impact the quality of education for students. A 2007 study by the National Bureau of Economic Research found that an increase in teacher absences has a direct correlation to reduced test scores. Since the proposed regs disincentivize the accumulation of leave, teacher absences are likely to increase, thereby negatively impacting the quality of education and forcing schools to rely on a substitute pool that is already stretched thin. To summarize, we believe there are 5 possible negative ramifications of the proposed regulations: new taxation, loss of retirement benefit, significant HR hurdles, a new and sudden operational burden, and a reduction in the quality of education we can deliver to our students. So what do we think will happen next? At this point, it's unclear, but the good news is that the IRS is still open to hearing comments from the tax base, and that means all of you. They want to hear about the impacts the finalization will have on your organization. And to date, the IRS has expressed they are surprised at the lack of comments that they have received thus far. So we urge you to make your voice heard and reach out to the IRS. While this sounds bleak, there is some good news. Through many conversations with our council, weekly internal meetings we've held on the topic, we feel confident that we can find creative ways to either implement new plans or amend your current plans so that you can protect accrued leave balances from taxation, preserve the value of the leave banks, and keep a valuable benefit that allows you to attract quality employees. As we await further guidance, we'll continue to communicate with the IRS in order to achieve a favorable outcome. Additionally, we will think of other ways to help you be prepared for whatever legislation is put into place. As Carolyn mentioned, we will have another webinar on February 22 at 11 a.m. where we're going to review some benefit restructuring options which comply with the proposed regulations, while still meeting the same objectives of your current benefit structure. So with that, I know we covered a lot of information today, and I would like to open it up for a Q&A session. I imagine there's going to be a number of clarifying questions, so we wanted to leave plenty of time to provide answers. Carolyn, has anybody submitted any questions yet? Well, there were a couple questions that have already come through that I've seen through the Q&A portal. So the first question is, when do we anticipate hearing something from the IRS? I anticipate that finalization of the regulations could occur as soon as this year. So what does that mean in operations? If the IRS finalizes the regulation in July, for example, the regulations would likely become effective January 1, 2018. So there's not going to be a ton of time to react to the finalization. Another question received is, can you review for me one more time what a bona fide plan is? Absolutely. I'd be more than happy to do so. The IRS is going to look at three factors primarily to determine if a plan is bona fide. The first is whether the amount of leave provided could reasonably be expected to be used by the employee in the normal course of business. So what does that mean in layman's terms? If an employee has, let's say, 2 months of leave accumulated, the IRS may not feel that that can be reasonably used in the course of employment, especially if somebody is nearing employment in the next year or so. In the private sector, you would often see somewhere between 2 and 4 weeks of leave carried over from year to year, and the IRS does not have an issue with that practice. But in the public sector, you oftentimes see months, if not a year worth of leave accumulated prior to retirement. And they clearly will have an issue with that amount of accumulated leave. Next, they're going to look at limits, if any, on the ability to exchange unused accumulated leave for cash or other benefits. And in the public sector, and there are a lot of questions in the Q&A about this, will this impact the ability to deposit the funds in a 403B plan or an HRA at the time of retirement? And based on how the rules are currently written today, we think that the ability to do so may actually impact whether or not the IRS views the plan as bona fide. And finally, they're going to look at whether the payment of unused sick leave or vacation is made promptly upon severance of employment. There's oftentimes practices in place today where payments are made 5 years post-employment or sometimes even longer, and the IRS certainly will look at the length of time in which those are paid out post-employment to make a decision on whether the plan is bona fide. And we touched on earlier that when reaching out to the IRS, we have asked them for safe harbors. And the reason that we are asking for safe harbors is specifically because of how these factors in determining whether a plan is bona fide.
Trent, this is Carolyn. Can you hear me now?
Yeah, I can hear you now, Carolyn.
Okay. We have a question coming in. Will these changes impact our ability to deposit accumulated leave payments into a health reimbursement account or a health retirement account? I'm assuming they mean health reimbursement account that is being used for premium payment only.
Yeah, great question, Carolyn. Based on what we've heard today, if the plan is structured in the way that it is today, where there allows for significant accumulation of sick leave, then I think it will impact the ability to deposit those plans into an HRA. Now, on our next webinar, we're going to be talking about ways in which we can preserve that. So I think there are ways that we can get around what the proposed regulations currently state today. It would restructure the benefit a bit and change the way and the timing maybe on when those funds are deposited into the HRA. But as it's currently done today, where it's paid post-retirement, these regulations could potentially impact that plan design.
Okay, another question. Does a severance plan that makes a contribution to a healthcare savings plan fit under this proposed regulation?
So severance plans are mentioned in the 457F regulations. In addition to sick leave and vacation time, they also went from stating that severance plans were exempt from 457 to bona fide severance plans being exempt. And so that change in the language bona fide with regards to severance plans really looks at the length of time in which that severance is paid out. For severance plans that pay the entire severance balance within 2 calendar years post-retirement, will still be considered bona fide and exempt from the 457F regulations. But if the severance plan pays out over 10 years into the HRA, that could be impacted by the final rules. Again, that's something that we're reaching out and we're asking for clarification from the IRS and looking for them to create a safe harbor so that way it's easy to comply with the rules.
Okay, great, Trent. Jackie is asking, so they will be taxed on the benefit, they meaning I'm assuming employees, will be taxed on the balance of their benefits each year or the year the benefits are accumulated. If it is each year, isn't that taxing each year for the same benefits?
That's a great question. So in that particular example, if somebody has, let's assume for a moment that they get paid out regardless and there's no significant risk of forfeiture that we discussed. If that individual has 20 hours accumulated this year and the rules were finalized, those 20 hours become taxable this year. But they roll over, and let's say at the end of next year, the person accumulates 6 more days. So their balance goes from 20 days to 26 days. Next year, it'll only be 6 days that would be taxable to that individual. So it wouldn't be retaxing the 20 days that roll over. It would just be an additional tax on the additional 6 days.
Okay, great. And Linda is presenting a scenario here. An employee is taxed during employment, having met the trigger criteria. So now the employee is still active and needs to use a sick benefit for which they have already paid tax. Is there a consideration to reverse or make a tax adjustment?
That is a great question, and that is one of the areas that we're specifically asking for guidance on, as HR staffs all over will need to know how to apply the rules. I would assume at this point that if the value of that leave is already taxed and they take that in a future year, that would be a non-taxable event to the individual. So I would assume that they wouldn't get taxed on it on the year it rolls over, and then again if they use that leave in a future year. But at this point, it's extremely unclear, and the IRS has not provided an opinion on that scenario.
Okay, thanks, Trent. I'm looking at some more questions here. When will the final rules likely be implemented? I think you already answered that question. Susan is asking, vacation and sick time is taxable when paid out or used, so aren't they being taxed twice?
Yeah, so on both of those questions, one, I think that it's important to reiterate when it might be finalized. We think that it could come as soon as this year, but with all the turmoil that's going on in Washington these days, it's possible that maybe this no longer gets the same emphasis that it had pre-election. So it is possible that maybe they don't finalize this year, maybe they finalize next year, but what is clear is we do need to be prepared. If the regulations are finalized, we will have to take some quick action to avert the negative consequences. And regarding double taxation, I mentioned this on Linda's question. I think that if it gets taxed on the rollover in this year, for example, and they use it 2 years down the line, my guess is 2 years down the line, they would be able to be paid without being taxed on the value of the leave that they use.
Thanks, Trent. Nicole is asking, is all leave included, vacation, PTO, and sick leave?
Yes.
All right. Tina is asking, is there a specific department at the IRS to submit our communication and concerns about these regulations?
There is. And as a follow-up to this webinar, we will provide an email to all the employees. We had drafted a template letter to be used as a comment to the IRS. And so we will email that to everybody who joined the call today. And it does provide some information in there on how to submit that to the IRS.
Rebecca is asking, can you please go through the scenario with Jane when she is eligible for retirement and when she was not?
Absolutely. So we're assuming that Jane, at the beginning of the example, was 46 years old, and the policy stated that she had to be 55 years old and 15 years of service for retirement. So at 46, there exists a significant risk of forfeiture because Jane may work at the district until she turns 55, but there's a possibility that she severs service before then and wouldn't be eligible to receive the leave balance to be paid. So at 46 years old, with having a significant risk of forfeiture, the balance of the accumulated leave is not taxable. And that's a key tenet on Section 457F, determining when something is taxable and when it's not taxable. If there exists a significant risk of forfeiture, the IRS says those funds are not taxable. So at 46 years old, if she had 20 days of leave accumulated, she would not be taxed on it. But let's fast forward to when she turns 55. So now she's met all of the requirements for retirement from the district. At that time, the significant risk of forfeiture goes away. So at the end of that year, whether or not she decides to retire, the value of her leave, and in the example, it had accumulated to 38 days. At that point, those 38 days become taxable to Jane, along with FICA taxes, if it's applicable for the position.
Great. Rhonda is asking, what impact will this regulation have on an entity that withholds federal tax on the employee's payment of accumulated leave at retirement?
Again, it depends on whether there's a significant risk of forfeiture, but at some point, we're assuming that taxation occurs, whether it's on the annual rollover for those that don't have a provision in place to restrict when it can be paid, or when they reach retirement age, as an example, when there is a provision on when it could be paid. So if it's taxed while they're employed, at the time that they separate from service or retire, I would assume that the amount that's paid out to them then would not be taxable because it had already been taxed throughout their employment. But this is an area that we are specifically requesting the IRS to give some examples and some safe harbors, so that way there's clear instruction to HR staff on how to proceed with applying taxation, whether it's while they're employed or at the time in which they sever and they pay out that balance, which may have already been taxed once.
Great, Trent. Kelly is asking, if we keep our sick days and the employees use this to pay for health insurance upon retirement, is this bona fide?
That's a tough question today based on the way that the regulations are written. I think it goes back to the factors that we discussed on bona fide. If there is a limited amount of leave that's allowed to be accumulated, the IRS may look at that as bona fide, and in that scenario, it wouldn't affect using sick days to pay for health insurance. But if the IRS were to evaluate the sick leave design and determine that the accumulation was excessive, thereby making it not a bona fide plan, then it would be taxed, and they could potentially use the post-tax money to purchase health care, but it doesn't give them the tax advantage that they currently have today.
Great. Pamela says, if I understand this correctly, you have said that if you have a bona fide plan, these proposed rule changes will not impact it. How do you determine if it's a bona fide plan?
So as we discussed in the presentation and in some of the questions that we've answered thus far, the factors are very vague and extremely subjective, which is why we continue to follow up with the IRS for safe harbors on this issue. But if the IRS looks at it and thinks that it's bona fide, then it wouldn't apply, and the leave program could continue on as it does today. But if they look at the plan and decide that there's excessive accumulation, that could cause the IRS to rule the plan's not bona fide. If they feel that the accumulation is occurring simply to be transferred into another benefit or paid as cash, they may consider it a deferred comp arrangement. Or if the leave payments aren't immediately paid on the time somebody severs employment, then it's a potential that they feel it's not bona fide as well. So it's not very clear today, as the proposed regulations are written, on exactly how the IRS would look at this.
Okay, great. Troy is asking, if the leave is taxed on your teacher in your example at age 55, is she taxed again next year on the total balance or just the new leave added?
In that case, I would presume at this point it's just the new leave added.
Okay. Teresa, if there is not an option to be paid out on their sick leave, only to convert to other leave types, does this affect us? Also, would this apply to vacation leave too? And I think your answer to that is yes.
Yes, it definitely applies to all leave. And the question is, if it can't be cashed out and paid out in cash, does that automatically make it not subject to the regulations? And I think I'll answer this in two ways. In one scenario, if you allow for the indefinite accumulation of leave, but they never get the ability to receive cash, or they never have the ability to convert that leave balance into say, a special pay plan or an HRA, then the IRS might not view the plan as bona fide But because there's always a significant risk of forfeiture, there's never a tax issue that occurs. But on the second issue on whether or not, on what the IRS considers when they determine if a plan is bona fide or not, they're looking at limits, if there are any, on the ability to exchange the accumulated leave for cash or other benefits. And other benefits is very vague, very subjective. So them taking the leave and converting it to another form of leave, quite possibly in the eyes of the IRS, could make the plan not bona fide. But as I've mentioned a number of times already, it's just not clear, and that's why we keep pressing the IRS to give specific examples and specific safe harbors so that way the HR staff know how to apply the rules.
Great, thanks, Trent. Tony is asking, if we allow administrators to bank vacation up to 30 days and allow them to sell these days at any time, therefore tax them at the time we pay them out, will this regulation affect us?
There's not a firm answer for that at this point. I think looking at 30 days, the IRS may not consider 30 days excessive. And if the IRS weren't to consider 30 days excessive, then they would consider it a bona fide plan, and it wouldn't impact how it's handled today. However, if the IRS felt that 30 days was excessive and the plan's no longer bona fide, then I do think there would be a taxation issue that would occur on an annual basis.
Okay, Tracy is asking, what if our sick and vacation leave payouts have a max 3 hours per year? What if our sick and vacation leave payouts are not put into a retirement plan but instead paid out in a check form?
Great question. So if they allow for a max of 3 hours of rollover per year, I would be very surprised if the IRS came in and felt that it wasn't a bona fide sick leave plan. 3 hours annually would only accumulate to a fairly small balance in comparison to some of the other leave balances that are out there today. So I think if it were 3 hours per year, I would be surprised if the IRS had an issue with that. But ultimately, unless we get some sort of a safe harbor from the IRS, it's more of an assumption versus knowing for a fact.
Great. Pamela asks, what about those organizations that suggest employees use their sick banks for short-term disability leave?
In that scenario, I think it becomes subject to how much leave is allowed in aggregate. So, for example, if they stated you can accumulate 30 days and use that for your elimination period on your short-term disability plan, if the IRS didn't feel 30 days was excessive, I think that practice likely would be fine. But it all comes down to what does the IRS consider reasonable with respect to an accumulation. If it's 30 days, anything less than that would be fine. Maybe if they came out and said even 60 days, anything less than 60 days might be fine. And I think as long as the IRS feels that the plan is bona fide, it shouldn't impact current practices today. But it all hinges on that one wonderful word of bona fide.
Jolie, if an employee has many days of leave accumulated and then have met the criteria for retirement, 55 with 15 years of service, and they are taxed for the leave, is that leave taxed every year over and over again? Actually, I think you answered this question before.
But it's worth reiterating an answer to that question because this is one of the more confusing aspects of how you would administer this new regulation. And once it's taxed, I don't believe you're going to find double taxation occur. But again, we would welcome comment from the IRS on that particular factor. But I think it would be reasonable to assume you're not going to see that same balance taxed year in and year out.
Great. Carol is asking, how do we know for sure if our leave or benefit language is or isn't bona fide? Would our legal counsel be able to tell us this, or who would be a good source?
So that's the million-dollar question. And we are asking the IRS every time that we talk to them and working through our legal counsel to help them craft some safe harbor language to give an idea of what a bona fide plan looks like. And if the IRS weren't to provide any safe harbors and they weren't to clarify what bona fide means, I think at that point, an attorney likely would be a good source to help determine if the plan is bona fide. We as consultants could certainly help take a look and provide at least some advice, though it not be legal advice or tax advice. We certainly could provide some assistance in understanding where the IRS stands on the issue. And I think ultimately, if the IRS doesn't provide a safe harbor or give some guidance, we're not going to know specifically what a bona fide plan is until we start to see litigation or the IRS coming in and auditing a plan and making a determination. But once that starts to occur in absence of everything else, we would start to be able to glean some insight into what they feel is bona fide and then could adjust accordingly.
Trent, once the final IRS regulations are handed down, how quickly do we need to, or how quickly can we move to react?
Great question. Typically speaking, when the IRS finalizes regulations, they usually give at least 6 months of notice, so that way employers have time to react and amend any scenarios that may be out of line with the regulation. So I would assume that if they're going to provide guidance this year, that it would happen by summer. And if it doesn't happen by summer, I would think that this likely would be kicked at least a year down the road. But we're certainly going to be watching the IRS and having conversations with them so we know, so that way we can provide guidance ahead of time and let people know when it's being issued if we get the heads up. And 2, once it's issued, we will immediately begin contacting everybody to talk about ways to either amend the structure or ways, and we'll talk about this again on the next call, ways in which that we'll be able to provide some amendments to preserve the balance or preserve the benefit that they're currently providing to the employees.
Great. We have time for just a couple more questions. Melanie is asking, if I have a 20-day year 1 balance and it rolls over, and in year 2 I accrue and use 20 more days, do I have any new tax events at the end of year 2? Is it the same balance as in year 1? And will I need to track LIFO and FIFO?
Yes, LIFO and FIFO, the wonderful accounting principles. I would like to think that if they're going to apply some sort of taxation, it would be first in, first out. So in that scenario, 20 days that roll over, if she were to use 20 days the following year, I would assume the first 20 she uses may be those that were already taxed. We will have to see, based on conversations with the IRS, to determine how they're going to look at that. But again, it's going to come down to whether the ultimate accrual total is allowing the plan to be bona fide or not. So if it allows 20 days to be rolled over in year 1, is there ultimately a 20-day cap? And if there is, maybe in year 2 she has 40 days available and 20 could roll over again. And if the IRS feels 20 days is sufficient for the plan to be considered bona fide, then I don't think that there would be a taxation issue that would occur. But if the 20 days that rolls over could roll over to an unlimited balance, then there likely is a taxation issue to occur, and that's where it would really be helpful if the IRS would let us know how to treat the leave, whether it's in, first out, or last in, first out.
One quick last question, Trent. What do you mean when you say value of the day? Is it the daily rate or the amount we have determined we will pay for accumulated leave?
That's another question that's unclear, but I would have to assume that it's going to be based on what could possibly be paid out at the end of the day. So looking at that, I'll give two scenarios. One, if the employer puts a limit stating that they can receive $30 for every day rolled over, then I believe taxation would occur based on it being $30 per day. If it's a scenario where they get paid at the rate in which they get paid when they retire, two forms of taxation may occur. First, let's say the individual makes $10 an hour this year, and they roll funds over, and it gets taxed at $10 an hour. And at the time that they ultimately retire, they're making $20 an hour. At that point, it's already been taxed once based on $10. So at the time they retire, if it's paid out at $20, my guess is the first $10 would not be taxed, but then the difference in value, the additional $10, likely would be taxed.
Great. Thanks, Trent. Thanks for answering all these questions. There's been a lot of them today. This is going to conclude our webcast for today.